So how do you overnight swing trade? Swing trading is entering the market with a specific stock or ETF or even a sector based on a technical signal. And you also exit the market based off of generally the same technical signal. Now that could be a moving average or MACD. There are a number of ways to approach this, but overnight swing trading is a little different. Quite often people get tired of day trading, staring at the screen, whether it's for a couple hours or the entire day. They want to be aggressive, but they don't want that emotional up and down of the minute-to-minute, hour-to-hour trading. Overnight swing trading can be a comfortable midpoint between traditional longer-term swing trading and day trading. It allows you to be aggressive with high rewards. What we are trading is referred to as the overnight gap. Yeah, you've seen it. The market closes at one point, then opens either up or down the next morning. The difference between the close and the open is the gap. This is one of my favorite charts. It's the chart of the SPY. And what it's showing you is if you had started trading the SPY when it started trading in 1993, and you bought it in the morning and sold it in the evening, well, you would probably break even or maybe even lose a little bit money to this date. However, if you had bought at the end of the trading day and sold the next morning, well, you would be up over 1,000%. That tells me the action is overnight. That graph is showing you results if you are only pointed up, meaning if the market went up the next morning, you made money. If the market went down, you would lose money. Which leads to the question, what if you could point either up or down? On average, the market opens up about 54% of the time, depending on the time range you're measuring. But let's imagine we could be correct 60% of the time, 65, 70, or even 75% of the time. Again, depending on the time frame and the type of market we find ourselves in. Imagine how much greater those overnight returns on average would be. And there are a few ways you can approach this. You can buy stock, you can short stock, you can buy ETFs that point up or ETFs that point down, such as the TQQQ or the SQQQ if you're going short. Or possibly use options if you want to be really aggressive. You could buy calls if you think the market's going up, or puts if you think the market's going down. And there's one more element we need to consider, and that is our signal. And of course, that's what we specialize in at SpyTomorrow.com, offering a free signal at 4 o'clock Eastern Time of either up or down. And of course, members can have deeper insights, which can be very valuable because up or down is great, but is it a strong up or a strong down? This is important because many of us like to use options to trade overnight. However, there is a problem with options if the market is flat. It's called time decay or theta. So we really do need a good market move to make money. So if it's a flat market, we may switch over to, say, leveraged ETFs. There is a disadvantage to overnight swing trading compared to day trading, and that is that we can't stop out if the market goes the wrong direction for us. If we think the market's going down and it goes up, well, we can't stop out overnight like a day trader could during the day and then maybe reset their trade. So we might often use hedges. In other words, if we think the market's going up, we may buy a 2-to-1 options ratio, meaning 2 calls to 1 put. That way, if the market goes down big, we could still actually make money. Many traditional day traders will scan the market looking for a very specific technical setup. And it could be as simple as an ETF crossing its 50, 200-day moving average. However, for overnight swing traders, it's a little different. We're basing our trades more on time with a signal letting us know when to get in, but not always when to get out. So we can get out first thing in the morning, or we could set a traditional time such as 10:30 or 11, depending on the type of market we're in, and just automatically get out at that time. So I often recommend that you focus on a very specific stock or ETF. In other words, get to know SPY, get to know QQQ or IWM or Apple, and know how it trades in different markets. Because if you're always jumping from one ETF or one stock to another, you really don't have that intimate knowledge of knowing how that specific security reacts during different times of the year and different seasons. Overnight swing trading is high risk, high reward trading. You can make big moves in your portfolio, 25, 50, 100% overnight easily, but you can also lose that. So that's why managing the risk is very important. Understand your risk tolerance. Decide what percentage of your portfolio will you risk each night, and keep consistent. Don't jump all over the place. Keep logs, make notes, understand what you're doing right, and understand when things go wrong. Understand and keep an eye on the news, because the news can easily change the mood of the market overnight. And so you may not want to risk a lot when there's an opportunity for a big market change. And that market changing news could come from political statements or government reports such as the CPI or jobs reports. And of course, don't forget about earnings season. What are the big names doing? What's expected? Are they going to go up or down this quarter? Overnight swing trading can be exciting and profitable without the grind of day trading. So test it out using some of your favorite signals. And if you don't have a signal, of course, head on over to spytomorrow.com and use our free up-down signal available at 4 o'clock Eastern Time. And I'll see you in the next video.